Hi, I'm Michael Regan with the Regan Team Home Loan Group, and welcome to this week's Real Estate Roundup for Tuesday, March 10th, 2026. First, we have last week's BLS jobs report or Bureau of Labor Statistics. This is a big market mover, and the market is anticipated about 50 to 60,000 jobs to have been created in the month of February, and it came in at negative 92,000. So clearly not a great jobs report. Then on to existing home sales. So existing home sales for February were up 1.7% month over month. They are down 1.4% year over year, but nonetheless, we only have a 3.8 month supply. A balanced market is 4.6%. So there's a lot of markets that it is still a seller's market, and 14% have sold above list price. Now to active listings for February. And I really want to show you this because I've seen a lot of negative media headlines and attention talking about how many more listings there are than buyers, and the market's out of control and it's going to crash, but the data doesn't back that up. So if we look at active listings for this year, you see that we're actually down 17% from what we were in January 2019. Now, 2019, I didn't hear anyone talking about 2019. The market was going to crash and it was a horrible time. No, 2019 was a very good market. A lot of inventory, a lot of buyers, a lot of movement. The inventory's been tight for a while, but nonetheless, you had a lot of demand in the market, and no one talked about that. Or if you look even years before that, you had even more inventory, and again, no one spoke about that we had way too much inventory, and home listings were super up. We didn't have that, and if you see the inventory that we've had the last several years, it's been pretty bad. Yeah, has it gotten better than it was, in 21 and 22? Of course it has. But that being said, we're still down 17% from where we were in 2019. So there isn't a glut of inventory. And as rates stay steady, and obviously this current military action is not helping us, but as long as things calm down, rates continue to go down, that's going to be really good because we're seeing the demand pick up already as rates get and hover around 6%. And a lot of people out there are buying, and that's going to eat up that inventory. Now, something that's thrown a wrench into lowering interest rates, and that's what's going on in the Middle East. With that conflict, oil prices have doubled and gas prices are going up, and they're going up fast. And this chart just shows you see gas prices over the months, and all of a sudden we've had a huge spike nationally in terms of gas prices. Obviously, California is even more impacted because we have made decisions that have made gas more expensive in this state. Now, the good thing is that if this or when this conflict eases and oil is able to be shipped more freely than it is now, you should see oil prices go down. But until then, that is inflationary. And anytime the market thinks that there's inflation, that's going to be bad for mortgage rates. And I'll show you what that did. But nonetheless, gas prices have spiked up. And if you've gone to the pump, you've seen that. Now we'll get to the charts and we'll see exactly what that spike in oil prices did to mortgage rates. Now, the good thing is today we're up 4 basis points, but if you look at the chart, you saw a lot of red. So red is bad for rates. So as soon as the conflict started and oil started to spike, all of a sudden mortgage rates got a lot worse. So they've clearly gotten worse than they were a week or two ago. Now, luckily, there was some news that the conflict may be resolving itself soon, or at least oil will be flowing much more freely. And so the market has rebounded a little bit. Clearly, we're not as good as we were a couple weeks ago. So it's one of those things that if you were looking at rates a couple weeks ago, obviously they've increased considerably because, again, oil prices went up. That leads to inflation. Anytime the bond market sees inflation, mortgage rates are also going to go up. So that's one thing we have to be cautious of. Now, we are going to see CPI, so Consumer Price Index, that measure of inflation is coming out tomorrow, and that will be impactful to the market. But the recent spike in oil rates won't be, or oil prices won't be shown in that yet. That always takes a little while to cycle through the system. But nonetheless, rates are still a lot better than they have been in the last couple of years. So don't let that stop you. It's just nonetheless realize that if you were looking at rates and you were starting to see some headlines in the fives, that's not that way anymore. Now you're back in the sixes for at least the average rate. So just be prepared for that because that spike in oil prices did drive rates up. That's it for this week's Real Estate Roundup. And don't forget, we specialize in cash flow loans for self-employed business owners and reverse mortgages. Have a great week.